For many American working professionals in their late 30s, 40s, and early 50s, retirement savings starts to feel more difficult right when income is supposed to be stronger. Contributions compete with mortgages, college costs, health insurance premiums, and rising property taxes. This video looks at why retirement saving often tightens mid-career even without a financial crisis. Retirement saving is often described as something that gets easier over time. Early in a career, income is limited. Later, income rises. Promotions happen, bonuses improve. The assumption is simple. As earnings increase, retirement contributions naturally follow. But for many American professionals, mid-career tells a different story. Between the ages of roughly 35 and 55, income may be higher than it was in the first decade of work. Yet, the ability to increase 401k contributions often feels constrained. Not because of poor discipline, not because of overspending, but because fixed and semi-fixed obligations rise at the same time. This is where retirement savings begins competing with ongoing obligations. Let's look at what typically changes mid-career. First, housing. By mid-career, many professionals own homes rather than rent. A mortgage replaces rent, and while that can build equity, it also introduces long-term payment stability. Even if the mortgage rate is fixed, property taxes rarely are. In many states, property taxes have risen significantly over the past decade, particularly in suburban areas where families move for schools. Home insurance premiums have also increased in several regions due to higher rebuild costs and climate-related risks. What once felt like a manageable monthly housing expense gradually becomes heavier, not suddenly, but steadily. Second, family-related costs. Mid-career often overlaps with raising children. Childcare, extracurricular activities, transportation, healthcare, and eventually college savings add layers of financial responsibility. Even for professionals with strong incomes, these costs are persistent and long-term. A 401k contribution is adjustable. A mortgage payment or tuition bill is not. So when income growth slows, which commonly happens after early career jumps, retirement savings becomes the flexible variable in a rigid structure. Third, health insurance and healthcare expenses. Premiums have increased across employer-sponsored plans. Deductibles have risen. Out-of-pocket maximums have climbed. For families, the monthly premium alone can rival a car payment. Healthcare costs are rarely predictable, but they are consistently present. When these premiums increase each year, even modestly, they quietly absorb room that could have gone toward retirement contributions. Fourth, career plateaus. Early career often includes rapid raises, 8%, 10%, sometimes more when switching companies. Mid-career increases are typically smaller. Annual raises of 2% to 4% are common in many industries, often matching or slightly trailing inflation. At the same time, expectations rise. Leadership roles bring stability, but not always proportional compensation growth. Bonuses may fluctuate with company performance. Equity compensation may depend on market conditions. So while total compensation might look stable on paper, real purchasing power may not expand meaningfully. This creates tension. Retirement guidelines often suggest contributing 15% or more of income. Catch-up contributions become available after age 50. Financial media emphasizes compounding and long-term growth. But mid-career professionals are operating within an already crowded financial structure. Mortgage, property taxes, insurance, health premiums, child expenses, transportation, everyday inflation. Each category grows gradually. Together, they narrow flexibility. There is also a psychological layer. In early career, retirement feels distant. Small contributions feel acceptable because time is abundant. In late career, retirement becomes near term and visible, often motivating higher savings rates. Mid career sits in between. Retirement is no longer abstract, but it is not immediate either. Competing priorities feel urgent and tangible. College tuition deadlines arrive sooner than retirement dates. Home repairs cannot be postponed indefinitely. Aging parents may require support. The 401k contribution, despite being important, remains invisible in daily life. Another factor is lifestyle stabilization. Mid career is often when households reach a stable living standard. Larger homes, established neighborhoods, reliable vehicles. These decisions are not extravagant. They reflect long term settlement. But stable lifestyles come with fixed costs. Once established, they are difficult to reduce without disruption. And unlike discretionary spending, fixed commitments do not adjust downward when income growth slows. There is also market volatility. Retirement accounts fluctuate. During downturns, account balances decline despite continued contributions. This can make increased saving feel less immediately rewarding, even if long term outcomes remain intact. Meanwhile, ongoing obligations do not fluctuate downward during market corrections. The mortgage bill remains the same. Insurance premiums remain due. Property taxes continue to adjust upward. So, mid career professionals often experience a subtle but persistent compression. Income grows slowly, obligations grow steadily. Retirement savings competes quietly. Importantly, this is not a crisis scenario. Many households remain financially stable. Bills are paid. Contributions continue. Progress happens. But the rate of acceleration slows. Data from retirement plan providers often shows contribution rates rising early in a career, flattening mid-career, and increasing again closer to retirement. This pattern reflects financial structure more than discipline. There is also the impact of inflation. Even moderate inflation affects multiple categories simultaneously: groceries, utilities, maintenance, travel, services. When inflation persists for several years, it reshapes baseline expenses. If income adjustments do not fully offset these increases, discretionary margin narrows. Retirement contributions sit within that margin. One more dimension is risk tolerance. Mid-career professionals often prioritize financial stability. Taking on side income risk, switching industries, or relocating becomes more complex with family responsibilities. Income volatility becomes less acceptable. As a result, the financial structure remains stable, but not expensive. The system prioritizes predictability over acceleration, and retirement savings must function inside that system. It's also worth noting the role of tax structures. Higher incomes may push households into higher marginal brackets. While retirement contributions can reduce taxable income, other deductions phase out at certain levels. Net benefit calculations become more nuanced. Simultaneously, contributions to college savings plans, health savings accounts, and other vehicles compete for available surplus. This does not mean retirement savings stops. It means trade-offs become more visible. Mid-career is often less about building from zero and more about balancing multiple long-term goals at once: retirement, children's education, housing equity, emergency reserves, healthcare readiness. Each goal is valid. Each requires funding. Income, however, remains finite. There is also the time compression effect. By the 40s and early 50s, the remaining investment horizon is shorter than in the 20s. Catch-up strategies feel necessary, but obligations remain heavy. Increasing contributions by several percentage points may require noticeable lifestyle adjustments. For some professionals, this is the first period where financial decisions feel constrained. despite years of steady work. And yet, this phase is structurally normal. The American financial life cycle includes expansion, stabilization, compression, and eventual transition. Mid career compression is not failure, it is often the result of accumulated responsibilities. The key observation is this: retirement savings feels harder mid career, not because income collapses, but because financial obligations mature at the same time, income growth slows. This overlap creates pressure without crisis. Understanding this pattern can clarify why progress may feel slower during these years. It explains why increasing contribution rates requires deliberate trade offs rather than automatic growth. Eventually, certain obligations decline. Mortgages are paid down. Children become independent. Income may stabilize at peak levels. Retirement contributions can rise again in later years. But during mid career, retirement savings operates inside a crowded framework. And for many working professionals across the United States, that framework is the defining financial reality of this stage of life.